All right, let's jump right into it. Welcome to another explainer where we take complex ideas and make them crystal clear. Today we're looking way past the brick-and-mortar facades of your local bank to explore the actual textbook mechanics that literally power our entire economy. We're breaking down the 6 core functions of commercial banks, and to do it, we're going to use a surprisingly fitting analogy.
Think about that for a second. A financial energy grid. We so often think of banks simply as giant static vaults where we just lock our money away, right? But as this quote perfectly captures, a commercial bank is a highly active, dynamic system. It takes in raw power, transforms it, and then distributes it right back out to keep the whole commercial engine humming. This energy grid metaphor, that's going to guide our entire analysis today.
Okay, here's our roadmap for this explainer. We'll start with the financial energy grid, look at powering up through deposits, distributing power via loans, keeping it flowing, boosting voltage with credit creation, and tie it all together with the engine of commerce.
Section 1. The Financial Energy Grid.
So, to really grasp a bank's function, we first have to understand its position in the broader economy. Just like a physical power grid doesn't just generate electricity out of thin air, it actually collects it from power plants and distributes it to homes and factories, a commercial bank acts as this vital intermediary. It collects idle cash. Think of that as the potential energy of the economy. Then it redirects it to exactly where it's needed most for active use. It connects the folks who have surplus funds directly with those who have a deficit, keeping all that economic energy moving.
Section 2. Powering up, accepting deposits.
This is the very first primary function of a commercial bank. It's the raw power intake for our grid. Banks basically offer 3 main ways to plug into this grid, and it all boils down to a fundamental trade-off between liquidity, how fast you can get your cash, and interest. Current accounts, those are for traders and businesses making a ton of frequent payments. There's 0 interest paid here, but you get unlimited checkable withdrawals, high liquidity. Savings accounts are more for households with idle cash. They give you a nominal interest rate, but with some limits on withdrawals. And finally, fixed deposits. These are for your long-term savers. You lock your money in for a fixed period, and in exchange for giving up that immediate access, the bank pays you a much higher interest rate.
Section 3. Distributing power, advancing loans.
Now, once the bank has collected all this power, it obviously needs to send it back out. That vault is not a dead end, guys. It's a revolving door. The deposits coming in from the left are seamlessly channeled right back out as loans on the right. This is the second primary function, and honestly, it's how the bank actually makes its profit. It charges a higher interest rate on those outgoing loans than it pays out on the incoming deposits. That spread, that's their profit margin.
But let's be clear, banks don't just hand out cash blindly. They advance loans in 3 highly specific, structured ways. First up is cash credit, which is incredibly popular with businesses. A limit is set against current assets like stock or shares. But here's the kicker. The borrower only pays interest on the exact amount they actually withdraw. Second, you've got outright loans. This is where a lump sum is just dropped into the borrower's account, and they pay interest on that entire sanctioned amount regardless of how much they actually use right away. And third is the overdraft facility. This is essentially a short-term lifeline specifically for current account holders, allowing them to draw checks in excess of their actual balance up to a certain pre-approved limit.
Section 4. Keeping it flowing.
So a grid isn't just about intake and output, right? It needs constant maintenance to make sure the energy actually moves efficiently. That brings us to our third textbook function, discounting bills of exchange. Imagine you're running a business. Someone owes you money in 90 days, but you need cash literally today to pay your own staff. What do? You take that 90-day bill to the bank. The bank hands you the cash immediately, minus a small commission fee for their trouble, and then they collect the full amount from your debtor when those 90 days are up. It's an absolutely crucial way banks keep commerce from just stalling out due to delayed payments. The fourth function is the facilitation of payments. Obviously, before digital transfers took over, checks were the absolute backbone of business, and they do still remain a vital instrument today. Banks provide this cheap, incredibly safe, and super convenient system to transfer funds from one party's account directly to another. No one has to walk around carrying briefcases full of cash.
The fifth function wraps up these daily maintenance tasks, agency functions. Essentially, the bank is acting as an agent for its customers. They'll collect your checks, pay your taxes and insurance premiums automatically, serve as foreign trade agents, and even act as underwriters for companies issuing new shares. They're handling the daily financial chores for a small commission, just keeping all the economic gears perfectly greased.
Section 5. Boosting voltage. Credit creation.
Okay, if accepting deposits and advancing loans are the basic wiring, this next part is where the bank actually boosts the voltage. I really want you to think about this question. How on earth does a commercial bank manage to grant more money out in loans than the physical cash deposits it actually takes in? It sounds mathematically impossible, right? But it's literally the foundation of modern banking.
Let's trace how this multiplier effect actually works. Say someone walks in and deposits 1,000 rupees in cash. That's our primary deposit. Now, the central bank requires the commercial bank to hold a certain percentage of that in reserve. Let's say it's a 20% cash reserve ratio. So the bank locks 200 rupees in the vault, but it loans out the remaining 800. The person who gets that 800 rupee loan goes out, uses it to buy something, and the seller then takes that 800 and deposits it into their own bank. That second bank keeps 20% of the 800 and loans out the rest. This creates a massive chain reaction of derivative deposits across the system. And because of the deposit multiplier formula, an initial cash injection of just 1,000 rupees, assuming that 20% reserve ratio, ripples through the multi-bank system to create a total of 5,000 rupees in bank deposits. The bank didn't print any new currency, but by systematically lending out a fraction of its deposits over and over, it quite literally created new credit, new purchasing power in the economy. It's wild.
Section 6. The engine of commerce.
So, the absolutely crucial takeaway here is that a commercial bank isn't just doing one thing. It is this incredibly specific combination of 6 interconnected functions. It accepts your deposits to gather power, it advances loans to distribute that power, it discounts bills, clears checks, and performs agency functions to keep the whole grid running smoothly without hiccups, and finally, through the multiplier effect of credit creation, it actually expands the total energy available to the entire town. Without these 6 pillars operating perfectly in tandem, the economic engine simply stalls out.
So I'm going to leave you with this thought. Every single time you deposit your paycheck, or even just swipe a debit card, you are actively participating in this massive, interconnected system. Where do you plug into this financial energy grid today? And how is your money being multiplied to build the economy right now? So I'm going to think about. Thanks for joining me on this explainer, and we'll see you next time.